Hi, everyone. I'm Todd Rosenbluth, head of ETF and mutual fund research at CFRA. I really want to welcome you to our latest ETF webinar, Are Bonds Different? Understanding Active Fixed Income ETFs. I'm here with David Braun of PIMCO, who is a managing director and portfolio manager. David, thanks for joining me.
Todd, thank you very much for having me. I'm super excited to be here today.
Yeah, we're excited for PIMCO to be a part of this. PIMCO is a leader within the fixed income ETF space, specifically the actively managed space. And we've been hearing a lot from our clients about active fixed income ETFs. I don't think they fully understand what they are and what they're not. And so this will be a great conversation. I'm going to lead us to the next slide here, which is just going to give us the overall agenda, the topics we are going to cover. I'm going to cover much of the early parts of this, talking about the ETF landscape, specifically active bond fund demand. We'll talk about how CFRA is covering the ETF universe. Then I'll bring David back in primarily to have a conversation about active bond ETFs. We'll then round out with just a bit of our commentary that we've written at CFRA on this space, and then take your questions. And I'd encourage you now, as well as throughout the presentation, to submit questions that you can during the chat box here. We'll get to as many questions as time allows. With that, let's move forward into the overall presentation. So we're now at $4 trillion and counting of ETF assets. This is as of the end of August. We now, the latest data gets us closer to 4.1 trillion. On the right-hand side of the page, you can see how this pie chart is broken up. U.S. and international equities are a lion's share of the overall pie. It's roughly 20% of the fixed income ETFs are roughly 20% of the overall universe. But what we've seen in 2019, as you can see on the left-hand side of this, is fixed income ETFs are really punching above their weight. The $148 billion that we've seen in the first 8 months is disproportionately towards fixed income ETFs. Well, we've seen that continue even in September, despite the fact that equity ETFs have seen strong inflows. Money is continuing to move into fixed income ETFs. They're now, as of yesterday, 55% of the overall inflows have gone to fixed income ETFs. Again, 20% is in the overall asset base, so more than double, close to triple the overall inflows of what we've seen. $104 billion alone have gone into fixed income ETFs. But as we see here on the next slide, this is an anomaly. We have only seen in the last 10 years just one time that we saw, and in 2009 is when that happened, as we were coming out of the Great Recession, and investors still had concerns about the overall economy, the overall market. They missed out on some of the equity gains, and we saw strong inflows to fixed income ETFs. But you can see in red that we had a bit of a dip in 2013, and then since 2013, we've been seeing a staircase climb of fixed income ETFs. We're now above that for equities, and we actually are on pace to knock out the 2017 record of $126 billion of net inflows that we saw for fixed income ETFs. Of course, that was the record year overall for the ETF landscape. Equity ETFs more than doubled, close to tripled where it is. So we're believing that we're going to see strong fixed income ETF demand continue heading into the fourth quarter. But I've likened this, I'm a Met fan, that the Yankees typically make the playoffs. The Mets rarely make the playoffs. We're in September, and there's a chance of fixed income ETFs and the Mets still making the playoffs. We're really hoping that's going to happen. You know, too many years of just equities dominating. We'll move to the next slide here. We're going to bounce a little bit between ETFs and mutual fund flows because we're talking about active management, and the data gets a little bit compelling as we move here. So I'm sure you've seen the headlines that active equity products have been out of favor, and we've seen passive equity funds actually cross over the threshold, have more money than active equity. It's not happening the same way within the fixed income space, and we'll get to the data in a moment. But we've seen strong inflows continue for fixed income mutual funds, both passive and active products, even though we've seen bleeding of assets continue. This slide only goes back to the middle of 2018, but the bleeding of active equity funds has been going on for a number of years. we had a bit of a lull. There was some volatility, obviously, in the fourth quarter of 2018, and active fixed income mutual funds saw outflows and then bounced back. They've recovered almost all of the money that flowed out in the fourth quarter within the first half of 2019. And that's, again, the sign of investors being more comfortable with active fixed income in a mutual fund wrapper. We're going to touch on that on upcoming slides in more depth with David. Let's move here to the next slide here and come back to fixed income ETFs and how they've gained market share. You can see the asset base has more than doubled, close to tripled in just over 2 years. The percentage of money that has gone that is in fixed income ETFs that are actively managed went from roughly 5% to it's approaching 10%. What we've seen this year, the flows have been even stronger. Active fixed income ETFs, and we'll get to some of the examples in a moment, have 13% of the fixed income ETF flows. So the category overall is doing great, and active fixed income ETFs are doing quite well in particular. David, I want to bring you back into the conversation. What I didn't mention is David runs one of the most popular actively managed fixed income ETFs, so you certainly have a sense of what's happening and how we're not seeing the same trends in equity as we are in fixed income. What's your thoughts on this slide here?
Yeah, I think these are great points. It's a great slide. We believe that, from a percentage of the total ETF fixed income pie, that we're past the point of peak passive. Obviously, passive is still larger than the active funds out there from a dollar amount. But as you can see here, in a little over 2 years, we've gone from about 5% to about 10% market share for the actively managed funds. And we think that's a trend that's going to continue. A couple of reasons why, and we have better slides on this later. But you're going to see later the outperformance of actively managed bond funds versus their passively managed peer group is real and quite compelling. And then also with volatility on the rise, with the state of the markets and the economy, with the Fed on move, that's created an opportunity for active managers to really generate some alpha, right? The kind of volatility in the marketplace provides kind of the tools for an active manager to generate alpha. So I think when you combine those two things, historical past performance of active managers versus passive, plus the volatile landscape that we're in right now, I think it makes for a great recipe for active management.
I'd agree, and we'll move to the next slide here to just give you a lay of the land and the products that are out there within the actively managed fixed income space. We've got the top 10 active bond ETFs based on assets under management as we ran the data at the end of August. We're going to spend a little bit more time on the ticker BOND, which is PIMCO's active bond ETF. That's more of a core bond product, but PIMCO's MINT is the largest of those actively managed fixed income ETFs, close to $13 billion, roughly $450 million of net inflows this year. I won't spend too much time on the rest of this list here, but you'll see a number of prominent firms listed either from the index, not the index, the ETF provider or the sub-advisory firm that is tied to the asset manager that's tied to this. So you are seeing more and more asset managers enter the ETF market using actively managed fixed income ETFs. And that's great, again, from CFRA's perspective. More choice for investors is good. You can be able to compare and contrast these products. It's also compelling to see some of the larger products are the ultra short-term bond products, but we are seeing products like BOND and others that are out there that are more core in nature. We'll move here to the next slide to just give you a refresher about the way that how CFRA looks at the ETF universe and how we look at that differently from the mutual fund universe. Unlike Morningstar, we rate ETFs versus ETFs and mutual funds versus mutual funds. I'll spend a little bit more time on the fixed income side of it, but we cover over 1,200 equity ETFs using our proprietary holdings-based analysis. What do our stock analysts think of the companies inside from a valuation and risk perspective? We incorporate other things like the expense ratio, the liquidity, the trading costs of an ETF to give a more holistic view. Fixed income ETFs, we're looking at the credit quality, the duration, and the yield of the portfolio, and then marrying that in with expense ratio, trading costs, other metrics like that. We cover 265 of the ETFs that are there. When you combine the roughly 1,500 ETFs that we at CFRA have a rating on. Just over a quarter, close to a third of that coverage universe launched within the last 3 years. We do not believe an ETF needs a 3-year track record. For analysis that's done on that prior slide, we are covering a number of the ETFs some of those that are less than 3 years old. On the mutual fund side of this, the lower half of this, just to remind you of the way that we look at mutual funds, we again use some of the same level holdings analysis for fixed income mutual funds, credit quality, duration, and yield. We are incorporating the fund's track record versus its peer group, turnover rate, that's more fund specific. What we're not doing, since it's not relevant, is there's no bid-ask spread. There's some technical analysis for mutual funds the way there are ETFs. And so we find mixing ETFs and mutual funds in the same rating universe to be a challenge. On the next slide here, I won't spend as much time on this slide, but just gives a more visual perspective, how we focus on what's inside the portfolio. We believe our approach is more forward-looking than Morningstar's, and we're incorporating things that they and others believe are important, including expense ratio, when doing our analysis. The next slide here gives you a bit more about how CFRA has focused on expanding our universe of data. In August, CFRA acquired FirstBridge Data, a leading data and analytics company that works with clients to provide investment insights and to help manage risk. We're really excited about this, that we'll be integrating the FirstBridge data, focused on holdings, focused on classifications, focused on core statistics, to really go deeper than we've already been doing within the ETF universe. So we're really excited to have FirstBridge part of that. For those of you that have access to Market Scope Advisor, you may notice that on the ETF tab or the thematic research part, we published an article today looking at the ETF universe at the end of 2014 and where are they now, what kind of products have had success, what have failed, what have closed. We really leverage the FirstBridge data. We'll be sharing more of that on an upcoming webinar. Now, with that out of the way, let me just bring David back in. You can now see what we both look like here. These are the topics that we're going to cover. I won't read these questions because we're not scripting this out, but these are the topics that David and I are going to touch on upcoming slides. So David, again, excited to have you here. We're going to move to the next slide to just talk about, you touched on earlier about how active fixed income has performed much stronger than the average active equity mutual funds. I'll let you just talk through this slide a bit more about what's happening with the blue versus the orange bar charts.
Yeah, thank you, Todd. So yeah, we believe the move into passive in the ETF space for fixed income has largely been an inadvertent move or accidental move, if you will. ETFs really came into their own as a vehicle in the stock or equity markets, right? Where that's where as Todd showed earlier, that's where the majority of the flow has been historically. It's starting to shift now. But you got a vehicle that came into its own in stock funds. And a lot of investors know the data here where the stock funds have struggled to beat their benchmarks, beat their median passive peer group. And thus, it was probably a natural connection to say, oh, ETF, equity fund, let's go passive. And you can see that here in the orange, where this just takes the last 10 years, the returns of the actively managed funds versus their benchmark, and what percentage of them are beating it. So just look at the first orange one, large blend. So large cap blended funds. Only 18% of the actively managers net of fees have beaten their benchmark, right? And similar for large growth value, et cetera. But then when you look at bonds, so again, if that's the orange data, we can understand why the ETF equity space is dominated by passive funds. What we don't understand is why the bond space is, because when you look at the blue bars, it's a totally different story. So look at the first column, the intermediate core and core plus. So this is your Barclays U.S. corporate aggregate benchmark bonds, bond funds, et cetera. In this case, this isn't just PIMCO funds, but all industry funds, 93% of the actively managed funds have beat their benchmark over the past 10 years. And then we've got some more data on how much have they beat it. Is it a basis point or two? No, it's even more compelling than that. Next page simply shows same cohort of funds. What is their average excess return over that 10-year period versus the index? You can see again over on the right, the large cap equity funds, the average excess return versus the benchmark is negative. Makes sense when only 25% are beating the index and 75% are losing, that you have a negative excess return. But look at the bond fund for that intermediate core and core plus category. On average, over 10 years, the excess beat versus the index's total return, the benchmark's total return, is 113 basis points. And that's very meaningful in a low-rate environment like we're in now and likely destined to stay in for several years. Right now, you've got a 10-year Treasury yielding about 1.7%. So 1.13% alpha, if you will, above and beyond the benchmark is very meaningful as a percentage of your total return on an index.
So, David, that's great stuff. We're going to stay here on this slide because what also jumps out to me on this slide, besides the excess return that's being generated, is that equities and fixed income get lumped together. But what we can see here, for example, high yield is an example of taking on too much risk. There may not be the same differential that's there. So whereas it's important for investors to understand the risk and the from a credit quality and a duration perspective, not all fixed income mutual funds are going to perform the same. Not all fixed income investment styles are going to perform the same. Same way on the right-hand side of this slide, you will see there are a couple of those peer groups or categories where value is being added. So I think the industry in general lumps active and versus passive together, and fixed income and equity together, and ETFs versus mutual funds together. And when you get into the data, you can break through the noise. I'm going to move to the next slide here about, again, what makes bonds different. Again, that's the title of what we're doing here. But I think many of our clients at CFRA came to us initially as stock research clients. They may be on this. They certainly have fixed income exposure as part of it. Perhaps they don't fully understand what makes the structure different, the segmentation that's there. So I'll let you drive a little bit on this slide here too.
Yeah, really 15 and 16 tell a good story. So I apologize if I go back and forth a little bit. A couple of things I want to talk about on why the results are. Why were the blue bars so much better than the benchmark, and why were the orange bars perhaps not as good as the benchmark? And it's really got to do with the structure of the marketplace, first of all. Right, the equity market is very visible, transparent, predominantly exchange traded, where the bond market is still largely over-the-counter traded. So there's less price discovery. It's a more opaque market, and that provides an information asymmetry to a large manager with deep portfolio management and trading team to kind of extract value in a less liquid, less observable market. Second, the size of the market. Right, the S&P 500, if that's your benchmark, has 500 securities in it. It's pretty simple. The Barclays corporate aggregate in the U.S. has 17,000 securities in it. So just a massive amount of securities in there. That creates structural opportunities where a talented active manager can figure out of those 17,000 securities, which are the ones that are attractive and which ones are not attractive, thus avoiding the unattractive ones and finding out of benchmark securities to beat those that you're not buying in the index. Another thing we talk about is this the first bullet in the blue, not all fixed income participants have the same goals and objectives. What we mean by that is the global bond market is over $100 trillion. And by our math, and we put a paper on this out on this a couple of years ago called Bonds Are Different, is over half, so over $50 trillion of the bonds out there in the world are held in the hands of what we would call non-economic investors that are buying and holding these securities not for alpha-seeking purposes. They're not trying to beat a benchmark. They're trying to manage foreign currency reserves or central banks with quantitative easing programs. They're trying to defease a long-dated liability stream like defined benefit pension plans here in the States and in other countries, like life and annuity insurance companies that need to buy bonds to defease long-duration assets. They're not seeking alpha on those bonds. So therefore, you've got half the industry or half the securities out there being bought by non-economic investors. The other half of us can go out there and pursue alpha, have fertile opportunity to do so. Another thing I want to talk about is in the middle, the index structure. The Barclays, the S&P 500 maybe turns over 4% a year, where someone drops out, someone comes in. The Barclays corporate U.S. Ag turns over about 40% a year, with amortization down on mortgages, with bonds maturing, and with new issues coming in. So that's just massive turnover that allows an active manager to figure out what's coming in and out of the index. And rather than mechanistically trading it, incurring transaction costs, et cetera, you can kind of figure out where the thing's heading and how you can beat it. What else do I have? And then in the orange there as well, the bottom 2 points, even if you did feel it was a prudent thing to do to try to replicate the ag and its 17,000 securities, obviously we would say don't do it. But even if you wanted to, because you believe that was the right way to run bond money, you incur a significant tracking error just because of the complexities of trying to match 17,000 securities with 40% turnover a year. So it's not like the S&P 500 where you get de minimis tracking error. I mean, go look at some of the stats. The tracking error on some of these funds trying to mirror the Barclays aggregate is quite high.
So, David, let me jump in here for a moment just to look at what's on the right-hand side of the segmentation. This I think is interesting as well because you've got especially the Bloomberg Barclays aggregate is in the investment grade only index. You've got high yield oriented products, active management, or fixed income in general. You can see moving between the credit spectrums, whereas within the equity space, large cap is going to stay within large cap and small cap is going to stay within small cap, but you tend to not find companies bouncing from one to another.
Yeah, so the green there, investor segmentation, it talks about as you allude to, look in the credit space of the index, right? We're going to show in a second what's in the index, but a healthy chunk of it is corporate credit, and that's perhaps the riskiest part. And you're giving a ton of responsibility to the rating agencies, right? If they do their analysis and they anoint a bond investment grade and thus index eligible, it's in there and you've got to go buy it if you're hugging the index. What we try to do at PIMCO is we have 70 fundamental credit analysts, and their job is to not worry about what the rating agency says something's credit worthiness is. It's to figure out our own view of that company's credit worthiness. And then that's how we make our decisions if we want to own it or not own it, not just because the rating agency says it's index eligible. And then it'll influence how we scale the position, and that'll influence how we trade the positions. The last thing I wanted to mention, I guess it's in the middle of 16, or towards the bottom, where we say index construction, since we're on that topic, is, for a bond index, it's the issuer weight is determined by the amount of debt the issuer has issued. This is a kind of a perverse concept in my mind, in that, think about what you're doing here. The more indebted a company is, i.e. the more bonds it has outstanding, the more debt it has, the more you're going to force yourself to buy. I always use the analogy if you, instead of being a bond investor, you ran a bank. You ran a small bank somewhere in rural America. And imagine if your lending criteria was when someone came through your bank doors and said, hey, I'd like a loan. Your first question, and really your only question, was, hey, how much existing debt do you have outstanding? And if their answer was, I've got a lot, you'd give them a big loan. If their answer was, I don't have any debt outstanding, that's kind of why I'm here talking to you, you'd pass on them. You wouldn't give them a loan. What we try to do at PIMCO when we're buying bonds is figure out why they have debt and not necessarily reward them for having a lot of debt and not necessarily penalize them for having low or no debt. So just kind of make our own decisions, separated from the fact of how much existing debt they have and thus not mechanistically buying them just because they have a lot of debt. Hopefully that makes sense.
It does. And so I want to just point the audience to a couple of the numbers that you touched on earlier in the prior slide, but we now have this up. Again, the overall size of the fixed income market, $105 trillion, more than the equity side of it, even though most financial media is covering the equity markets and individual companies reporting results. We at CFRA, we cover individual stocks as well for our clients. The number of issues, again, over 300,000 issues versus roughly 14,000 or so issues that's there. We often hear a lot about that and getting in the weeds here about the ETF universe being, and too much money is going into fixed income ETFs, even though it's coming off of a very small base, where it is $105 trillion is the fixed income ETF market. We're 3% of that perhaps is what's happening in certain investment styles. There's a lot of individual bond trading that's happening, both at PIMCO from an individual perspective, where it tends to fly under the radar. So I don't know if there's anything you want to add to the overall market size here.
Well, I think you properly point out. So look, the ETF fixed income market is tiny compared to the overall global market at $105 trillion. So for someone like us, we're vehicle agnostic. And if there's investors out there who prefer the ETF chassis, whether it's for the daily liquidity or the daily transparency, we want to make sure we deliver our strategies to those investors in the chassis they prefer. So given that it's starting at such a small base, we feel it's got tremendous runway to kind of And you're seeing this, as you pointed out in the year-to-date data, to continue to grow as a piece of that larger pie.
So thank you for that. We'll move to the next slide here. We at CFRA published research within the past week touching on this about what's changed within the Bloomberg Barclays Aggregate Index in the last 10 years, coming out of the great financial crisis. I keep coming up with different names for it. Apologies for that. But we've seen since the end of 2008 to June 2019, the duration, the interest rate risk is roughly 2 years, more duration for the ag. You've got more credit exposure, and in particular, more triple B credit exposure. So that's the riskiest of the investment grade area. And one would think that you'd get rewarded for that, but because the fixed income universe is different now versus it was 10 plus years ago, the yield is about 150 basis points lower than that. So investors shouldn't be okay with taking on more risk and less reward, but they certainly seem to be. The ag is extremely popular. ETFs that are tracking that are extremely popular. David, are you okay with getting less reward for taking on additional risk?
No, and that's why we're trying to run an actively managed fund, right? So, yeah, if you look at just, I like to say this is not your grandfather's aggregate, right? So in the old days, it was less credit, less duration, and higher return. Fine, maybe go out there and just try to hug it and get that. But now you've got, your two biggest risks in a bond fund are going to be interest rate risk, as shown by the blue bars here, and credit risk, as shown by the maroon bars. And they're both up significantly over the last 10, 11 years. Why are they up? Why is the duration 2 years longer? Well, look, we're in historic low rates, right? And the people who are in the index, the lenders that are in the index, mainly the U.S. Treasury, because Treasuries are the biggest component, U.S. households who have mortgages, because agency MBS, mortgage-backed securities from Fannie, Freddie, and Ginnie are the second biggest component of the index. And then the third biggest component is corporates. It's basically a three-trick ponies: Treasuries, household mortgages, and corporates. And look, those are three very smart borrower groups. And in this low-rate environment, they termed out their debt and they borrowed more longer-term debt. That's why the index, the blue bars here, has gone up 2 years in just 11 years. That's a lot more duration risk. Similarly, why have the maroon bars or pink bars gone up so much? Same concept. We're in a low-rate environment, relatively low credit spreads, and a near insatiable demand for high-quality income-producing bonds. So corporate issuers have issued more and more debt into this environment. Once-in-a-lifetime opportunity to issue debt at low rates, to term out your debt, issue more 10 and 30-year debt than shorter-term debt. And quite frankly, today's financial engineering on the corporate side is not all the securitization stuff we saw, 12, 15 years ago that led to the great financial crisis. It's borrowing from the bondholder to reward the equity holder, right? So you borrow in the bond market, use that money to buy back stock or do special dividends to shareholders, or to do aggressive M&A that's accretive to the shareholder and dilutive to the bondholder. That's why leverage is up. That's why the triple Bs have doubled in size. You see that 7% with triple Bs, now 14%. So the riskiest part of the corporate universe, the triple B that's right above high yield, has doubled in size. Right? That's financial engineering. That's adding leverage to the balance sheet to reward the shareholder and hurt the bondholder. So what we're trying to do is get a benchmark like volatility with higher reward, because we can source you bonds that aren't necessarily benchmark eligible. Therefore, they trade with a more structural risk premium, i.e. a higher yield. We can add diversification in the portfolio, so we're not just a three-trick pony with treasuries, mortgages, and corporates. Diversification, one of the few free lunches out there, where you can increase your upside reward and reduce your downside risk, and just trying to get you, more reward for similar or less risk than the generic index.
Well, I want to move to the next slide here, just because I touched on earlier that the ag has, it's rules-based in nature, only investment grade, only triple B and above companies. And the slide is showing here that if somebody did credit research effectively, as opposed to relying on the rating agencies, you'd be able to deliver alpha. This is something that active management, I think, has been able to do. One of the reasons active management has beaten the ag is the ag doesn't go take on additional credit risk and often find rewards. There's some other indices out there that do offer a bit more holistic and broader way of this. But maybe you can just talk about how PIMCO in particular finds this to be worthwhile focus of the credit space.
Yeah, great question, and it's a really good slide, so kudos to you for creating it. So let's first talk about what is a rising star. So it's in the footnote. A rising star is a credit, a corporate bond that was once triple B or double B, and it rises to get its investment grade back. So it rises from double B, which is high yield, to triple B, which is investment grade. And what we plot on the x-axis here is time. So 0 is the day it gets upgraded from double B to triple B, and anything negative is the days before. So all the way to half the year before, the minus 180 days, to a half year after its upgrade. Okay, in that PIMCO, we have 70 fundamental credit analysts. Again, I mentioned we're not just taking the rating agency ratings and trusting that. We're doing our own ratings homework. And obviously, those 70 credit analysts, their first job is to play defense, meaning get a PIMCO PM out of a name that's going to default or a triple B that's going to get downgraded to junk. But while they're in there studying these companies, why not play offense? And that's where rising stars come in. So as they're studying double Bs, figuring out if they're going to single B or defaulting, you know, they're going to find several of them that are like, hey, this is an unloved credit by the rating agencies. We think it's got a path back to triple B. You know, it could stabilize its leverage metric, improve its leverage metrics, and get its triple B back. Because look what happens. Look at the orange line. These are rising stars, again, that were once double B and make it to triple B. So go draw a vertical line at 0 and look to the left. So go a half year before to that 0. From a half year before, so if our analysts can identify one of these names a half year before they get their triple B back, we're going to make, you know, on average, cumulative excess returns over triple B of nearly 5%, right? So you start at 0% on the y-axis all the way to the left, and by the time you get to 0 on time, the day it gets upgraded, you've made, the orange line is crossing over that 5% return threshold. And then if you wait another half year after it is, so on that time 0, as soon as the index rebalances at the next month end, it's now in the index. But what you'll see is for the next 6 months after it's got its triple B back, you're only getting 150 basis points of return, not even. So all the money's made on that first 500% return in the 6 months prior to getting its investment grade status. So once it's in the index, everybody knows about it, and the money's already been made. So what the team and I are trying to do at PIMCO is use the really strong credit work of our 70 credit analysts and try to figure out which of these double Bs are going to get back to triple B.
So that's great coverage of that slide, and again, the value add of going deeper provides for investors and for your investors, for our investors as well. We'll move here to the next slide. We are big believers at CFRA focus on cost. We've long included the expense ratio in our mutual fund and our ETF research. I thought it was worth highlighting the differential between some of the more popular categories that investors are focused on, and part of why we think that actively managed fixed income funds tend to do relatively well is there's a much narrower gap between what they're charging and the nearly free index you can get with ETFs that are there. So, you know, ultra short and core plus, all considerably lower than the 100 basis point or more fees that the average actively managed mutual fund investor is paying. And again, fees eat into your return. So we at CFRA have been including that. I know others are now making a switch and being a bit more cost conscious. We're excited about that. Investors should be paying more attention to fees when they're doing their due diligence from a fund perspective. We'll move here to the next slide here. I think this is interesting. We've touched on a bit of this, but David, I want you to, in a moment, to just talk about how you and the team look at the fixed income world as much from a top-down macro perspective and combine that with the bottom-up approach to it. But you touched on earlier about the turnover. I think it's worth highlighting that fixed income ETFs, bond ETFs, are not static. They're rebalanced and reconstituted on a monthly basis. They're known as passive vehicles they're more passive vehicles. But as new issuance happens, as bonds get redeemed, as bonds get upgraded and downgraded to the investment grade or the speculative grade categories, there are changes that are taking place within a fixed income ETF that's index-based that probably fly below the radar. But I want you to tee this up before we get to the next slide about how you and the team are doing top-down research?
Yeah, so PIMCO, everything, the whole investment process starts with our quarterly forums. One where we look out every May, we look out 3 to 5 years. That's our secular outlook. This process has been around for 30 plus years, helped us navigate and get out of harm's way going into the great financial crisis. Post the crisis was when we called for the new normal and new neutral rate environment, which is low growth, low rates globally. So it really has served us dividends in the past. And then the other 3 quarters, we focus more on a cyclical horizon, meaning, okay, with that 3 to 5 year view as the backdrop, how are we going to make our clients money and how are we going to position portfolios for the next 12 months to kind of, take advantage of market opportunities. So what we're trying to do, I mentioned diversification before. I can't emphasize that enough. Maybe in the stock world where your winners can double or triple in price, in the bond land, the best you're going to get is your coupon back and your principal back and maybe some capital appreciation if you buy it below par. So you really have to control your downside. And one of the best ways to do that is diversification. Make sure your active risk positions are spread out across the market. And given that we have over 250 portfolio managers, we're not a mortgage shop. We're not a corporate bond shop. We're a go where the opportunities are shop. So we believe we have expertise in all parts of the global public fixed income market. And my job as a portfolio manager is to deliver that to you as the investor, a diversified portfolio that, maybe deliver volatility commensurate with the index, but is much more resilient on the downside and hopefully provides more upside return. And then active management. This is interesting because a lot of people think of active management as active trading, like, day trading, whipping around a lot. And that's certainly a component. But unlike the index, the index turning over 40%, any turnover I have or active management in portfolio is by design, not just mechanistically rebalancing to an index. So what I mean by that is, our active trading is going to be rotating out of one sector into another sector if we think that's a more attractive opportunity, rotating out of a single name into a different name in the corporate bond space, or rotating within a name on a different part of that issuer's curve, so maybe selling 3-year bonds and buying 10-year bonds, et cetera. So that's kind of the active trading piece where we're trading to either reduce risk, increase reward, cultivate relative value opportunities, et cetera. But a bigger part of active management is having the skill, courage, and conviction to just actively position yourself off of, the well-known generic benchmarks out there, right? So I think a lot of people, even some active managers, they take a lot of comfort in not deviating too far from the benchmark, right? That's not what we do at PIMCO. If we think the benchmark is unattractive or components of it are unattractive, we're not going to own that part of the benchmark, and we're going to go find something else to invest your money in. So that active positioning, and we're going to get to this, I think, in a couple of slides later, can really drive a lot of the excess returns, and then the active trading around that active positioning kind of augurs up those excess returns.
Well, that's a great setup for the next slide here, which is, so again, BOND, the PIMCO product. I want to make the word bond can be synonymous. I've used it 7 different ways during this presentation. The ticker BOND, the PIMCO ETF. You'll see in one of the columns, the index is that we keep referencing the Bloomberg Barclays Aggregate Index, and the differential. I want to have you tackle this from a couple of perspectives. Obviously, we can certainly see having more exposure to what we're referring to here as a securitized part of the fixed income market and less exposure to government-related products. Let's focus on the duration side, if we can, initially, of how you think of, so you touched on duration and credit being the 2 main areas. We'll come to credit in a second. How are you positioned from a duration perspective within these areas?
Yeah, good question. So, the BOND, as you mentioned, that's the ticker for the fund. Got to be one of the best tickers out there. It's so self-explanatory what the fund is, right? It's a bond fund. And so the duration of the index is something like 6 years. You showed this earlier. It was like 5.75. So bond can technically go from anywhere from 2 to 8 years of duration. However, look, we get that people are buying this as kind of their cornerstone ballast fixed income allocation that's going to be in their portfolio. We didn't even talk about this concept, but why do bonds have a home in one's portfolio? It's to buffer the volatility of one's equity portfolio. And we saw this in fourth quarter when stocks are selling off 15, 20%, depending on which stock fund you're in. So it provides that negative correlation or the insurance versus equity holding. So given that as a backdrop, and that I know clients are buying this as their kind of cornerstone ballast bond fund, we're never going to deviate too far from the index. So view it, most likely plus or minus a year Right now, we're just a smidge underneath the index, about a half year under. It's ironic because a lot of people look at our U.S. government-related piece of significantly lower than the index rate, and they're like, well, you must be way underweight duration because that's where a lot of duration for the index is coming from, the treasury component. But there's so many other ways to manage your duration in this portfolio, and holistically, we're right there with the index duration, but underweight the richest parts of the index, which are the treasuries.
So I think what's interesting here, knowing what we know at CFRA about the ticker BOND, the investment grade credit looks like you're in line and you're not taking on active calls within this slice of the market. But we touched on a prior slide about the credit research that PIMCO is doing. So how within the investment grade credit space are you aligned versus the benchmark?
Yeah, great observation, Todd. So the devil's always in the detail, right? So this shows, PIMCO has almost no conviction on credit, investment grade corporate credit. The index is 25%, we're 24%. But the devil's really in the detail. You can't just look at an overall percentage of market value. So for instance, we're roughly, we're meaningfully overweight financials, roughly double the index weight in financials. Because if you look what's happened since the great financial crisis, the re-regulation that's happened to banks, the reduced risk appetite by the senior management and the boards of these banks, they are holding impeccable levels of capital and liquidity and very little proprietary risk taking. So they have massively delevered their balance sheet. That's why they're all rising back to single A or double A. We want to lend to someone who's overregulated, holding a lot of capital, holding a lot of liquidity, and not taking much risk. That's who you want to lend to. So we're very overweight financials, and I'm talking top tier financials, even going down in the capital structure. So some preferreds and some of the AT1 structures out of Europe, and then we're offsetting that with being significantly underweight the non-financial universe, because I already talked about this, and we showed that with the slide of 7% triple Bs going to 14% triple Bs. There's been significant re-leveraging because the activist shareholder has all the power right now, not the bondholder, in the non-financial universe. So we're half the weight in non-financials, and then within that, we're very picky on what we're buying. So we like things that are secured and have covenants to protect us. So a lot of the REITs out there, we think are attractive bonds right now. Things with hard assets and huge barriers to entries like pipelines look attractive to us, et cetera. And then the other thing I'd mention, and further devil in the detail, where we are on the curve. Like I mentioned before, corporations are very smart. And when you're in low rates with flat yield curves, you issue more 30-year bonds. 30-year bonds are now over 8% of the Barclays corporate index, and we pretty much own none in BOND because we think the slope between 10s and 30s, 10-year corporate to 30-year, is not really commensurate with the increased volatility, the lower liquidity, et cetera. So therefore, the team and I are positioning very light in 30-year bonds and really overweight the most attractive parts of the curve, which is in that, call it 3 to 10-year part.
Well, we certainly, as we move to the next slide here, we at CFRA are certainly devil in the details kind of folks. On the right-hand side of the screen here is a sample of our ETF research. I touched on earlier, we at CFRA rate more than 1,500 equity and fixed income ETFs. This is a screenshot of earlier in the month of the ticker BOND. We are doing fundamental analysis, looking at the credit quality of the portfolio, the duration of the portfolio, and the yield. You wouldn't be able to see this in depth on this here, but we can certainly follow up with folks to send them a sample of this report or other fixed income ETFs that both PIMCO and non-PIMCO asset managers offer, because we think you need to go beyond the ticker, beyond the label, beyond the expense ratio, and do your homework to make sure you're understanding what your clients are exposed to. The left-hand side of the screen, which is more of an article, is something that we published in August using the newly acquired data from FirstBridge. We dug into the fixed income ETF universe to understand where the money was going, what asset managers were winning, who were punching above their weight, to again use a metaphor I've done a couple of times on this, and highlighting who have been some of the winners within this space at the fund level as well as the asset manager level. So again, a sample of some of the thematic content that we published on our platform. On the next slide here, if you are a client of us using MarketScope Advisor, you will certainly be aware of this weekly newsletter that our marketing team does a great job of taking the content that we publish from a research perspective and making it look much better and more digestible and make it easier for you to not have to go find the content that we publish within a given week. The more popular articles get highlighted here from myself, from Sam Stovall, our Chief Investment Strategist, from our equity research team. If you're not receiving the newsletter and you want to, please put your contact information in the chat box. We'll certainly be happy to add you to that distribution list. Some folks are accessing our research not through MarketScope Advisor. Absolutely no reason you couldn't get access to the great content there as well. With that, I'm going to open it up for the questions that have been coming in. Thank you to everybody that have submitted questions. We've gotten a lot of, we went through the deck rather extensively, and I appreciate, David, you for doing that and providing such great insight. So we're probably only going to touch on a couple of questions. One that came in, David, that I'll handle, and one I think is more appropriate for you. So I'll start with the one for you, so I catch my breath after the question. I think so the question is basically getting around to the fact of how do fixed income ETFs and how do fixed income ETF managers handle the market stress? We certainly saw in the fourth quarter of 2018 money moving out of some of the active mutual funds within this space. I think there's a fear that everyone is going to rush for the exits. How do you see that? I guess, how did you handle the fourth quarter?
Yes, I get the question. Everyone seems to think that kind of a run on the bank or liquidity crisis is the bugaboo for ETFs. And look, I'm sure you've done your research on this. Perhaps for some of the more off-the-run, idiosyncratic, smaller parts of the bond market that have ETFs, perhaps you got to worry about it there. But think about what this is. This is core bonds. This is investment grade, the highest quality, largely U.S.-centric, the deepest bond market in the globe. So on a vehicle like bond and the competitor funds it competes against, I think the concerns of illiquidity due to the ETF chassis are largely overplayed and not really the concern that should be on people's mind. Our fund has a cash create redeem process that keeps the fund trading close to NAV and eliminates a lot of the premiums and discounts, keeps the bid offer tight on the fund. Like I said before, we're vehicle agnostic, and whether these securities were delivered to an investor in a mutual fund or a separate account or the ETF, that in and of itself, the chassis that is, in our mind, doesn't alter the liquidity of the underlying investments and thus the vehicle. So so far as we've seen with this fund, the liquidity concerns are largely overdone.
Well, I'll add to that with a couple of points. One, that I think investors, and this isn't to the person who asked the question, but investors don't fully appreciate how much of the ETF trading activity is between investors and not impacting PIMCO or any of the asset managers that are running it. Roughly between 5 and 10 to 1 of the ETF, fixed income ETF trades happens in the secondary market, leaving the asset manager out of the equation. And so it's just you as the person asking the question and myself trading amongst each other and not impacting one another. And what I found in the ETF space is there's a lot of folks that are happy to run into the building because they don't believe the fire is actually a real fire, and they see opportunities to be able to pick up bonds and bond ETFs trading at a discount. And so that gap narrows quite quickly. And so I think that there's a fear out there that is not legitimate for investors. And then I would say is that whereas PIMCO offers both active mutual funds and active ETFs, other asset managers only offer one or the other in this space. And we're seeing, whereas mutual funds will sometimes see outflows given a period of time, ETFs are being used as the go-to vehicle from a liquidity perspective, which is, again, a great thing if you're running an ETF or you're invested in an ETF. The second question, which I'm happy was asked because I think it's a great one for us at CFRA to be able to tackle, is we've seen risk-taking being rewarded in 2019 within the fixed income ETF universe. Do we at CFRA think that is going to continue? We don't. Our ETF universe and our ETF research looks at duration as a risk, not a reward. And so ETFs that take on higher duration above the ag, for example, gets viewed less favorably in our ETF research. An ETF that is slightly below or lower is viewed more favorably on it. This year has been different than what we've seen beforehand, where the longer duration products that are out there, indexed or actively managed, have outperformed. And we've seen a number of prominent actively managed mutual funds and ETFs that are protecting the downside more, lag slightly behind. We think strong track records matter. We think you can certainly take a look at what active management has done in all periods of time to be able to do that, and that's part of the way that we do research on ETFs. So thank you for those questions that have come in, and for the sake of time, I'm going to move us forward because we at CFRA have been very busy. We're going to have a very busy October. For those of you that enjoy our webcast, the first of the October webinars is listed here on the screen and is going to include my colleagues from the equity research team looking at the technology platforms and legal risks, and you're going to see a blending of our forensic accounting and legal research team with our fundamental analysts that cover the technology and communication services and consumer discretionary companies tied to your prominent stocks, Alphabet, Amazon, Apple, and Facebook. We cover those companies from a variety of perspectives. You'll find out more information about that. You can see the link to it. I believe we're going to follow up with everybody as we follow up for this replay in the coming days and weeks about the upcoming webinar. We certainly hope you tune into that. With the next slide, I'll thank David, and we'll get you through very quickly the disclosures and disclaimers that I need to make sure that you see. But David, I really appreciate you joining us here in the CFRA offices. We think this has been a great webinar, and best of luck in running the fund going forward.
Well, thank you to you, Todd, and to CFRA for having me today. I really enjoyed the conversation, and hope to be back someday. Thank you.
Thanks a lot.